A fund that didn't exist 6 weeks ago has already doubled. The Roundhill Memory ETF, ticker DRAM, launched on April 2nd and closed Monday near $55.80, up approximately 107% since inception, a gain that would be remarkable for a decade, delivered in a single quarter. That number alone does not explain why it happened. What makes it worth examining is what was happening in the broader market while it did. Monday's session opened with oil front and center. Brent crude pushed above $103 after President Trump rejected Iran's ceasefire response, calling it totally unacceptable. Saudi Aramco CEO Amin Nasser warned on an earnings call that the global energy market has lost approximately 1 billion barrels of supply since the Strait of Hormuz disruptions began in late February, and that normalization may not arrive until 2027, even if routes reopen today. That warning sent energy names sharply higher and pulled attention toward geopolitical risk as the session's defining force. Meanwhile, the S&P 500 and Nasdaq extended their record runs, with the Nasdaq closing above 29,000 for a second consecutive session. Inside that rally, the optical networking complex posted its own double-digit surge. Applied Optoelectronics jumped 24%. Lumentum climbed 17%. Coherent rallied 13%, on earnings showing 51% year-over-year revenue growth driven by 800G transceiver demand from AI data centers. FuelCell names followed. FuelCell Energy surged 18%. Plug Power gained 13%. Bloom Energy added 12%. The session narrative was energy disruption and AI infrastructure, but neither of those framing was where the most concentrated capital movement occurred. That distinction belonged to memory. The DRAM ETF's top holdings, Samsung Electronics, SK Hynix, and Micron Technology, have been executing on a demand curve that hyperscalers telegraphed 2 quarters ago, but that broad equity positioning only began to reflect in April.
The mechanism behind the DRAM ETF's move is not simple supply and demand. It runs through a specific choke point in the AI infrastructure stack that took time to become visible in revenue lines. High bandwidth memory, the variant required to feed Nvidia's H100 and H200 GPUs at training speeds, cannot be substituted with conventional DRAM. SK Hynix holds the leading position in HBM3E production. Samsung is ramping behind it. Micron is qualifying its own HBM3E with major hyperscalers. The constraint is not price. It is physical yield at advanced packaging steps that neither China nor any alternative supplier can currently replicate. Applied Materials' announcement Monday of a $5 billion co-innovation partnership with TSMC at its new EPIC Center in Silicon Valley carried a detail relevant here. The facility is specifically designed to advance the packaging and interconnect technologies that make HBM viable at scale. AMAT is up 74% year-to-date for the same underlying reason as DRAM. The bottleneck has shifted from chip design to the physical infrastructure that connects chips to memory at speed. CoreWeave reported a $99.4 billion contracted revenue backlog at the end of Q1, nearly 4 times its year-ago level and up roughly 50% from the prior quarter. CEO Mike Trader disclosed that 75% of the company's target of more than $30 billion in annualized revenue exiting 2027 is already under contract. That backlog is not a forecast. It is signed commitments that require GPU clusters, which require HBM, which requires SK Hynix and Micron to continue executing on constrained yields through 2026 and into 2027. The DRAM ETF's 31% gain in a single week reflects a market repricing that backlog's downstream implication for memory supply. The reversal condition sits in plain view. If hyperscaler CapEx guidance softens, Alphabet, Microsoft, Meta, and Amazon have collectively committed approximately $700 billion in AI infrastructure spending, a figure that Wall Street itself has begun to question on per-token economics. The demand curve supporting HBM pricing flattens before supply constraints do. That sequencing matters. Memory is a forward-booked commodity. If orders cancel, producers are left with capacity that took 18 months to build. The 2017-2018 DRAM supercycle ended not when demand disappeared, but when Samsung accelerated capacity expansion into a demand plateau, collapsing spot prices by 50% within 6 months. The current cycle has a structural difference. HBM production cannot be ramped as rapidly as conventional DRAM, but the termination mechanism is the same, a demand signal revision before supply response.
The unresolved question from the mechanism above is not whether HBM demand is real. It is whether the $700 billion hyperscaler commitment survives the per-token economic scrutiny that Microsoft CEO Satya Nadella was implicitly navigating Monday in the Musk versus Altman civil trial.
Nadella testified that OpenAI's for-profit conversion was crucial to pursue its mission, and that Microsoft's investment posture depends on that structure remaining intact. That testimony was about governance, but the subtext for capital allocation is direct. The hyperscaler AI buildout is premised on a model of monetization that has not yet been demonstrated at the margins those commitments require. The historical parallel tightens here. In the 2017 supercycle, the inflection point came when smartphone memory demand, the cycle's demand anchor, began showing inventory digestion signals 6 months before consensus acknowledged it. Today's anchor is AI inference compute. The signal to watch is not hyperscaler capex announcements, which are lagging indicators, but HBM allocation letters from SK Hynix and Micron to their top customers. When those letters start carrying delivery deferrals rather than allocation tightening language, the cycle is turning. 2 conditions define the range from here. If the U.S. CPI print Tuesday morning, expected at 0.6% month-over-month after March's 0.9%, comes in below consensus, it would ease Federal Reserve pressure and extend the risk on positioning that has concentrated capital in AI hardware names, including memory. The DRAM ETF has a short volatility profile in that scenario: constrained supply, rising contracted demand, and rate expectations moving in its favor simultaneously. The breakdown condition is a demand revision, not a macro deterioration. If any of the 4 major hyperscalers, Alphabet, Microsoft, Amazon, Meta, revises its 2026 capex guidance downward in the next earnings cycle, the HBM order book softens before SK Hynix or Micron can redirect capacity, and the premium embedded in DRAM's 107% run compresses faster than the cycle built it. The 2017 analog suggests that compression, when it comes, takes weeks rather than quarters. What would falsify the current trajectory is not a macro shock, it is a single line in a single earnings call that says AI infrastructure spending is being optimized rather than expanded. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.